Hey guys, welcome back to Essential Facts. Again, my name is Tanya, and today I want to talk about auto loans terms. I think people seem to have a little misunderstanding of what auto loan terms are based off of interest rate, um, the value of the car, the loan amount, and things of that sort. So let's talk about it. So obviously your auto loan interest rate, you get a car loan, it's going to be based off of, your credit. So if you have obviously good credit, then you're going to get more of a preferential rate. If your credit is just mediocre, the rate is going to be higher. If your credit is bad, you're not going to get financed at all the conventional way. Or if you do get financed, it'll be outside the conventional way, meaning outside of a bank, maybe like a buy here, pay here. So, you know, obviously a good credit score definitely helps with the rates. So in today's environment, the rates are just again astronomical for everything for, car loans, mortgages, credit cards, just, personal loans, just anything you can think of that requires, rates or lending. The rates are just crazy right now. So hopefully with this new administration that the rates will, start decreasing, fingers crossed, of course. But so again, when you take out an auto loan, and it just depends on the financial institution. A lot of your commercial lenders are going to be similar in the type of terms they offer. So you have a term that can be 3 years. You have a term that can be 4 years, 5 years, or you can do 6 years. So basically, that equates to a 36-month term for 3 years, 48-month term for 4 years, 60 months for 5 years, and 72 months for 6 years. Every once in a while, you might get a lender who will go out to an 84-month term, which is 7 years, but most are not going to take it out that far because the car is going to lose its value along the way. So let's look at the first thing here that affects the interest rate. And I want to make sure I'm looking at my notes here because I want to make sure that I'm, actually hitting everything that I want to hit once again. The model of the car obviously is going to make, a difference in what type of interest rate and term you get for the loan, especially the term. Because if it's an older car, a car that's usually, I would say, older than 7 years, has more than 100,000 miles on it, that is going to have um, a higher rate, interest rate, if you will, on it. And the term is not going to be as long because no lender just can't see the value. It just doesn't make good business sense to put a long term on a car that's, we're in 2025. The car is like a 2014 or something like that, or a 2015. It just doesn't make sense putting a long term. It's just not, the value is not there in the car to hold a loan out that long. Even though they are making the money from the interest, it still has to make sense. So if you have a car that's usually under 7 years old, under 100,000 miles, the bank is going to will and deal with you more as far as your term on the loan. And, um, you know, not necessarily the interest rate because the interest rate is going to be largely in part based off of your credit score. Okay. So another thing they're going to look at again, like I said, the credit score, your history plays a huge role in it. How have you handled your credit in the past? If you had a car loan in the past, they see that on the credit report if it was paid off. Delinquencies, things of that sort. So if you're buying or shopping for a new car, they're not going to look at it necessarily as hard, the finance manager per se is not going to look at it as hard if it's a new car and your credit is good because they're going to see if that credit score spits out, at 740, 750 or higher, then, it's going to give you a little bit more flexibility with the loan. So also I gotta say the loan amount, makes a difference. They're not gonna take a loan out um, or do a long term for certain loan amounts, for certain dollar amounts. It's just, it doesn't make financial sense for them to do it. So the best thing that you want to do really is, think about what kind of car you want. Obviously, the value of the car. They have calculators under, the internet. You can just Google it, based off of, what it can't tell you is it will ask you the car, the year, how much it costs, things of that sort, how much you're looking to put down on it. They'll ask you what you think your credit score is, and it will spit, some numbers out. But again, keep in mind that's just in a good case scenario. If anything, all parameters are like good and they're like looking almost like darn near perfect. But again, let me go back to the interest rate. So the interest rates again is going to make a difference in a term. Those two kind of like go hand in hand a lot. You can have a phenomenal credit score and the interest rate can still be higher depending on how long of the term you take it out for. So if you take it out for 36 months, and let's say your credit score, I don't know, it's like, 790, 800, and you take it out for 36 months, well, they're probably going to, spit out a nice, rate for you. And today, a nice rate for a car for a 36 month loan is, on a new car is going to be anywhere between like the high fives and six, somewhere in the 6% range. If you take it out longer, you start going to 48 months, you start going to, 60 months, 72 months, then that's when they're going to start increasing the rate because now it's a greater risk because you are making the term longer. Even though the bank is making money off of you with the interest, they would still rather for you to, sometimes have that shorter term. And that's kind of a gift of having a lower interest rate when you have the shorter term. So if you have a used car, it's kind of the same difference, but used cars rates are always going to be slightly higher, even if you have good credit and you do a shorter term because it's a used car. It may already have 4 years into it. You might already have 5 years into it or 6 years into the loan already, but it's going to be a slightly higher rate. And like I said, again, it's based off of the term. Now, again, depending on how old the car is, the bank will make a determination on how long they can go with the term. Because again, they're not going to take a car that's older and as time is going on, it's getting older, and stretch it out to like 7 years, or sometimes like even 5 years. Um, so definitely, think about which ones you want to get first and foremost because it's a game. I mean, everything, just honestly, everything about a car, buying a car, is a game you're playing. From the time you walk in the door to say, I want to buy a car, up until the time you start talking about the finances, with the interest rates, and so forth. So, some companies, when they are offering new car deals, or they might be offering like, a certain interest rate, for if you're buying it straight out, and if you're leasing it, it's going to be a different interest rate. But that's a whole different conversation because it's a lot that goes along with that, buying versus leasing. a car. I just kind of want to stick to the terms of it. So, um, yeah, so think about that. Let me just make sure I hit everything that I want to hit. Okay, so yeah, that's pretty much everything that I want to hit on it at this point. So just keep in mind if you have any questions in particular about, the car loans, just know that again that the interest rate is going to be based off of the year of the car is going to be based off of how long you take it out, and it's going to be based on your credit score. So keep those in mind. And, I always tell people, know what your credit score is. And well, it was more of a mystery for people back then because when I used to sell cars back, way back when, people didn't know what their credit score was because you couldn't get a free copy of your credit report each year. So I would, if I were you, you can get a free copy of your credit report to see what's on there, to see what they're going to try to use against you, so they can charge you the higher interest rate. Or you can get a lot of credit cards now. If you have a credit card, a lot of credit cards now gives you the option of clicking on a button on under their site, under your information on their site. Once you log in, it gives you the option of see what your credit score is. Now, the caveat to that is that it's only going to pull from one of the credit reports. So it just depends on which one they are using, whether it's either TransUnion or Experian. A lot of them don't usually use Equifax for it. I don't know why, but TransUnion and Experian are the two that you're going to see on your information when you log into your credit card account or your loan account, where I ask you, do you want to see your credit score? Is the information is usually coming from either TransUnion or Experian. Like I said, Equifax, uh, they pull it, for certain things, but for the most part, you're going to get TransUnion or you're going to get Experian that the institution or the car dealership is going to pull from. Now, the only other thing I want to just throw in here too, that if you do not have good credit, and I know once upon a time, buy here, pay here was a big deal. If you want to do a buy here, pay here, I mean, unless you just really, 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 really have a car, but if your sole intent is trying to rebuild your credit, make sure that they report to the credit reporting agencies because it could be a buy here, pay here, and people are like, "Oh, I thought it was being reported to the credit reporting agencies." No, because usually a car dealership in of itself, if they're doing the financing in-house, it's called in-house financing. If they're doing in-house financing, a lot of times they're not reporting to the credit reporting agencies. Like I said before, on some of my other videos, prior videos, that it costs a company or organization money to report every month to the credit reporting agencies. And most of, these buy here, pay here in-house financings are not going to report to Equifax, TransUnion, Experian every single month because it's costly. You will again get your larger institutions who are going to, or your finance companies like Honda Finance or Hyundai or whoever GM. Their finance company, of course, they're going to report because they're a big organization. So just remember that if you're doing a buy here, pay here type situation. I don't even know if those are still big or not now. I really don't know. Like I said, I know once upon a time they were. But if you're going to do a buy here, pay here, find out if they're reporting to the credit reporting agencies and don't just let them know. Don't just let them say, yeah, 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 we do. Find out concrete if that's the case. But like I said, the buy here, pay here's are usually done for people who has um, unfavorable credit, basically. And they're charging you a much higher interest rate if your credit isn't favorable. I mean, look, I mean, institutions, these commercial banks, they will do the same thing. And, these finance companies will do the same thing. They're going to charge you a higher interest rate if they can finance you. Let's say your credit score is 690 or 680. They'll finance you, but it's just going to be at a much higher interest rate. So, whereas, again, like I said, a person who may have an 800 credit score or a 770 credit score, if a 36-month term is starting at, in today's environment, if it is starting at high 5, 6% for 36 months, and can go up to 8%, under 72 months right now, for good credit. So imagine how much it's going to be if your credit is in the sixes, like 680, 690, on when they look at it. So, you go like, let's say you go 60 months, 5 years, and you're going to probably have a rate probably about like 10, 11, 12%. Could be up to 15% that they'll charge you right now for the interest. But also keep in mind too that even though the rates are high right now, just in general, you get a car loan, and it works the same with mortgages, same difference, or personal loan, whatever. When the rates start falling down, start decreasing, you can always refinance it. You can refinance it and just get a better rate if you qualify for it. So, yeah, that's all I have for you guys today with the car loans. I know that's a big topic right now with people buying cars and the way the economic environment is with the high interest rates. Why is my interest rate high when I have good credit? Again, I say it depends on the year of the car, the term, and how much they're financing. So, um, hit like, give me some comments down there. Let me know what you think. If you have any questions, shoot them out to me, and I will get back with you. Other than that, you have a great rest of your evening, and goodbye for now.